Every month, portion of your income goes to the never-ending payment to insurance. Car, home, health, all things nowadays require insurance. But where does this money even go? And how do all these insurance companies rise up to be empires? It's easy to be curious about how these companies make massive profit off of you, where your money goes, and exactly how insurance companies make their money. Insurance firms build their operational strategies on the principles of accepting and spreading risk. The core insurance framework revolves around consolidating risk contributions from individual policyholders and dispersing them across a broader spectrum. Typically, insurance companies make their profit through dual avenues: collecting premiums in return for insurance protection and subsequently investing these premiums into income-generating assets. Just like any private enterprise, insurance companies aim to promote their services effectively while also reducing administrative expenses. Every insurance company has two main types of expenses. The first one is called claims, which are payments the insurance company has to make to its policyholders in case they run into some problems. This expense and, say, benefit is basically the reason policyholders are clients at the insurance company. These payments can cover things such as car repairs, if it's an auto insurance company, or death benefit if it's a life insurance company. For example, if you have home insurance and get into a damaging flood, the insurance company can pay for your losses. The specific type of claim varies depending on the type of insurance company. The other significant category of expenditures that an insurance company must cover consists of various operational costs essential to maintaining the company's functionality. This encompasses a range of expenses such as the salaries of actuaries who play a critical role in the company's operations and thus are considered ongoing expenses. Additionally, it involves expenditures relating to technology infrastructures, including computers, laptops, and other technological equipment necessary for the company's operations. Furthermore, these costs encompass office supplies such as paper, as well as various other outlays like advertising and commissions. All these factors contribute to the overall expenses incurred by the insurance company. So, insurance companies need a lot of money to stay in business, to have enough money to cover all possible losses and operational expenses, but then to even make a big profit. So it is important to understand how they do so. To begin, insurance companies generate income from their policyholders. Policyholders are required to provide payment known as premium to the insurance companies when they hold a policy. For instance, if you have a car insurance, you're likely familiar with the concept premiums. As a policyholder, you must regularly pay a premium, typically on a monthly or a weekly basis, to the insurance company. Essentially, anyone with an insurance policy has to contribute in the form of premiums. These payments can take various intervals, including annual, monthly, or weekly, depending on the type of insurance and the specific insurance company. At times, policyholders may choose to make a single lump sum payment, which covers their insurance for an extended period. Premiums can manifest in diverse formats, but they usually involve consistent payments such as an annual, weekly, or monthly. Therefore, a massive amount of money is being generated by all the customers' payments being made periodically. Furthermore, not everyone runs into trouble. Therefore, there are some clients who, in the end, might not even need insurance claims to help pay off losses. Therefore, insurance companies can continue to make profit off those customers' premiums without needing to pay them. However, a lot of these companies are massive companies and empires. Therefore, profits only off premiums is still hard to believe. So now things get intriguing. The insurance company takes the funds received from policyholders and embarks on investing in various financial vehicles. Among these options are bonds, shares, mortgages, just to name a few. To elaborate, they acquire these assets, effectively placing their money on these investments while expecting future returns. Typically, the aspiration is for the value of these assets to appreciate over time. Subsequently, the insurance company may potentially sell them at a higher price than initially purchased, or receive regular payments in form of coupons for bonds and dividends for shares. These periodic payments are akin to interest payments, offering investors a steady income, possibly on a monthly, quarterly, or annual basis. Hence, these are the means by which the insurance company anticipates recouping funds from its investments, either through dividends, coupon payments, or selling assets at a profit in the future. Over the span of several months or years, the insurance company will begin to witness a return on its investments. This return can manifest when they sell bonds at a higher price, receive dividends or coupon payments on a regular basis. However, it is essential to note that this process takes time, possibly spanning many years before these returns begin to materialize. The timing can be such that dividend and coupon payments may only start arriving quarterly. This essentially is how companies generate revenue, however. They invest their funds endeavors to earn more than they initially invested. Once they cover their expenses and claims, any surplus becomes their profit. So that essentially is how insurance companies make their profit. So why do many people think that insurance companies are scams? Understanding insurance isn't overly complex. It's a business built on the premise of guarding against potential losses by reimbursing individuals for their financial setbacks. However, the aim is to have fewer disasters occur, enabling the insurance companies to collect more in premiums than they pay out in claims. However, this business model is fundamentally flawed, as disasters do occur. A single significant disaster can not only financially cripple the insurance company, but also leave policyholders without their anticipated compensation. It virtually is impossible for any insurance company to fulfill every policy if all claims were to be made simultaneously. So, insurance companies are then incentivized to deny claims. Furthermore, insurance companies are a business that sells coverage and is dependent on minimizing payout in line with that coverage. Every business aims to keep expenses low and revenues high in the general sense. However, when the product being marketed is essentially money, things can become intricate. This complexity is amplified when the money is intended for safeguarding one's health and life, especially when discussing health insurance. Overall, that is how insurances work and how they make their money. I hope you learned something today, and please do stick around. This is Paradolia, all things money, business, and economics. Take care.